Good morning. Welcome to Thursday's edition of Bazaar Morning Call. The Gift Nifty is suggesting a muted start, a flattish kind of an opening. 13 points up right now, but lots of individual actions will dominate today's trading session. Our research team is standing by with CNBC-TV18's list of top stocks for the day. And Nigel, let me start with you. UltraTech Cement, that's the big one.
Well, that's right. Surprise, surprise. UltraTech has announced that they're extending their presence in the construction value chain. By that, they mean that they're making their foray into the cables and wires business. The total capex that they've laid out is around 1,800 crores. They're going to be setting up a facility in Bharuch. In the next 2 years, they expect operations to commence. That's by December 2026. What attracted them? Well, the industry itself has been growing very, very well in 13 to 14% or thereabouts. Industry size is expected to go from 80,000 crores to 1 lakh crores or thereabouts. And also maybe some kind of benefit with their RM sourcing, raw material sourcing, aluminium, copper from group company Hindalco. They're looking at focusing on strengthening their building products division, which is known as UltraTech Building Solution. And they already have close to 4,400 outlets. Margin-wise, well, the margins will be relatively lower, but the ROC on cables and wires is relatively better. So that's the mixed bag coming out to there. What the street will not like, though, capital allocation was. That could be one factor that will weigh on them. And the other factor is, some part of the street believes they could have done it under Grasim. How do the numbers stack up? They're going to be putting 1,800 crores. The revenue potential will be 7 to around 8,000 crores with margins in the vicinity of around 11 to around 12% or thereabouts. For them, the total capex is only around 10% of their annual capex. So very, very small. And as we know, the operating cash flows per year for UltraTech is more than 10,000 crores or thereabouts. Jefferies, they highlight there could be a capital allocation concerns, but they say if there's a knee-jerk reaction, it provides a buying opportunity. Expect the stock, though, to open up in the red because of this diversification away from their non-core business, that is, towards a non-core business like cables and wires. But Upasana, your companies may feel the heat. Suddenly you have a new player in there, and the fear is this the pains moment for the cables and wires guys? Give us a quick analysis.
Certainly, Nigel. Now, cables and wires space will be in focus today with the entry of UltraTech as competition may intensify for the existing large players. Mind you, Birla Group has a strategy to remain in the top 2 position across the business verticals it operates in. Now, if we look at the FY24 market share of the top players, Polycab stands at 26%, KEI stands at 12%, followed by Havells, which stands around 11%. Now, in terms of valuation, the current multiples of the existing players are on the higher side, but 20% of its peak seen 6 months back. Now, looking at the capex plans of majority players, they are on the higher side is what they have highlighted in Q3 FY25 as well, giving a higher capex guidance for upcoming years. Hence, the margins of these companies will also be in focus of how they scale it up going forward. Now, Jefferies believes that they foresee a lower impact on Polycab as compared to the other housing and B2C players like Finolex Cables and Havells. And lastly, Morgan Stanley believes that the new competition is certainly a surprise, but not a concern going forward. Hence, all these companies will remain in focus, and I expect all of them to open in red today.
All right, Upasana, thank you very much for that. In fact, we have the management of KEI Industries joining us to talk about this, and we'll get their perspective. We'll also have Mahesh Badang of Centrum Broking to talk about, the other side, right? What does it mean for UltraTech for a diversification like this? So that's coming up at 9:30 this morning. NBFCs and MFIs in focus, some reprieve, some relief, maybe. Abhishek is here with that. Abhishek, morning.
Well, largely to do with the NBFCs as well as banks loans to NBFCs. So that will be in focus, not the NBFC MFI, because this rule of, relaxation of risk-weight asset that RBI has put out is largely for bank loans to, NBFC MFI players and not for NBFCs lending to the MFI sector. So RBI has reduced risk-weight requirement for lenders, given the fact that if you take a look, the banks, loan growth to NBFCs has come down from around 30% YY loan growth that it was prior to November of 2023 to right now, as of December, it was just 7% on a YY basis. So this has or might have given some, good feeling to RBI that it's time to reduce the risk weight asset requirement that they had actually increased in November of 23. So they have restored or reduced the risk weight asset requirement requirement for lenders. Microfinance loans by 25%. So if a bank has loans to microfinance segment, that RWA requirement has been reduced by 25%. And bank loans to overall NBFCs also will reduce by 25% with respect to risk-weight assets. So we have IFL Securities note which states that 7 to 170 basis point of CET1 benefit is seen for lenders, especially banks. So higher benefit for Bandhan Bank, Bank of Baroda, Ujjivan and IndusInd Bank. Back to you.
Thank you for that. But Abhishek, you're also watching Azad Engineering.
Well, sources tell CNBC-TV18, Rima, that Azad Engineering has launched a QIP. The issue size is about 700 crore. Issue price is about 1,280 crore, which is at a discount of, 1.8% to SEBI floor price and about 5.6% to Tuesday's closing price. So equity dilution would be around 8.5%. The promoter lock-in post this fundraise is about 60 days, and the BRLM to the issue is ICICI Securities and others. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Let's hop across to Vinny. She's here with some more stocks and news. Morning, Vinny.
Good morning, Nigel. So firstly, let's start up with Dr. Reddy. We're expecting green on the screen for this one. US FDA has concluded the inspection at its Hyderabad API manufacturing facility, which is an important one for the company. API accounted to around 11-12% of the revenues in FY24. While obviously this is an EIR, which is Establishment Inspection Report, coming in for this facility with a voluntary action indicated. So positive sign for this one. No major concerns coming in here, and that is why a green. Prestige Estate, on the other hand, we're expecting red here. The Income Tax Department has conducted some search operations in its registered offices as well as branch offices. That was on February 25th is when they started it. And the details of the investigation are still pending, but the impact of the financials is also something that we're watching out for. As of now, the company is cooperating with the Income Tax Department, but this will be key to watch out for if there's going to be any major financial impact coming in on this front. Lastly, we have Mastek that is also in focus. They've secured a multi-year, multi-million-dollar contract. This is from the UK Public Service Department. The estimated value of this is around $85 million spread over a period of 2 years. So keep an eye out on Mastek. We're expecting green here as well. The stock had seen a decline of 22% on a YTD basis. Positive sign is what we could see here.
Okay, all right, Vinny, thanks a lot for that. Well, I'm looking at Vesuvius India, and the numbers actually were mixed because on the top line, you had a super growth of close to around 23%. Good going out there. However, the margins came down to around 16% or thereabouts. Remember, for a brief period, we had margins at 19 to 20%, so they've cooled off a little bit. The problem was in terms of the gross margins, which did see a contraction. So that's why we have the EBITDA margins as well that did come out. The profit number, though, was a little bit higher. That's because the other income was more or less flattish, and the effective tax rate was relatively lower. The kicker for the stock was that, in fact, they've announced a stock split, so now it'll become more affordable, high amount of participation could be there. Going with the tinge of green on this one, though the numbers were more or less mixed. Well, let's hop across to Manisha. She's here to tell us about ONGC as well as Oil India. Morning, Manisha.
Morning, and thank you for that, Nigel. Well, I'm looking at crude oil prices because we've seen a very sharp decline come in for this one, so much so that we are now trading below $69 a barrel for the U.S. crude oil prices. That's a 2-month lows, and with this, not just that we've broken below 70, but the trajectory clearly seems on the weaker side. Two things to watch out. One is the U.S. and Russia conversation, where that war seems to be now taking a step forward in sense of peace there. And if the Russian supplies start coming into the market, well, you could be looking at higher supplies then. The second thing is about the U.S. crude inventories, which also have surged, and markets do believe that the tariffs, if they do come as the conversation continues to be reiterated, then you could be looking at the Chinese demand going down and the economic slowdown leading to further decline in fossil fuel demand there. So these are the three factors that are weighing onto the crude oil prices right now. We are looking at a negative in sense of crude prices for this year also, down by nearly 4% YTD.
Manisha, thank you for that. Here's a quick recap then of the top stocks this morning. Stocks with positive news flow are Vesuvius India, Dr. Reddy's, Mastek, NBFCs, banks, microfinance stocks. Stocks with negative news flow are UltraTech Cement, Cables and Wires stocks, Azad Engineering, Prestige Estates, Oil India and ONGC. We will slip into a break on that note. On the other side, we'll connect with Dipan Mehta for some fundamental stock talk. We'll also have the management of Sirma SGS joining in to discuss the quarter gone by and the outlook going forward.